Hey traders, welcome to this week's Global Macro Outlook. So usually we run through the news and all the events of the week and what to look for. This week we're going to do things a little bit differently, and we're going to run through our technical framework of the current global macro picture from a kind of overview, longer term time frame perspective, just to give you an idea of exactly what we're looking for in the markets and what we've been looking for basically since May of 2020. If you go back to our video which we labeled a friendly warning for friends and investors, you can find our full breakdown there. It's a fairly short video. This one will be a little bit longer. And then you can also check out our 2021 FX market preview, which basically runs through the same thing and where we're sitting. I just want to update that video and show you exactly where we're lying in that framework and why I think it seems as though things are starting to change. We'll have to be watching very closely for a shift of narrative moving forward. So just getting into the charts, I'll show you exactly what I mean. So it all starts with this gold-silver ratio. Basically, the gold-silver ratio is an identifier as to whether we are working in inflationary/reflationary conditions or whether we are in a deflationary environment. So anytime silver outperforms gold, very similar to what we saw in 2008 to 2011 in the first round of QE, we saw an inflationary event. Or it's more of a reflationary event as the government tried to kind of boost up the economy using fiscal and monetary means. And eventually what that led to was a European debt crisis as Greece defaulted on its debt in 2011. And that turned us into a whole deflationary move, basically from 2011 all the way up to the COVID-19 crisis. Then following that, what we had was obviously the COVID-19 response, huge amounts of stimulus, huge amounts of quote-unquote money printing, which led to the whole inflation narrative. And again, basically another 18 months or so of inflationary environments. And since then, we've started to see a little bit of a change in that narrative. As you can see, there's a little bit of a shift back towards a deflationary environment. And I think a lot of this has to do with as I've been saying, the Chinese property crisis is part of it. I think it's more broad than just one place is having a crisis, the beginning of a crisis. What we're seeing here is, I believe, an emerging market crisis. These are the guys that are really struggling with their debts, with their societies, with their economies, following the COVID outbreak, following the lockdowns, and all the economic damage that's been done in that. Now we're starting to go back to what I believe to be that deflationary environment. So we're seeing the same thing, very similar thing in the copper gold chart. The copper gold ratio very much in line with economic demand, economic growth. When economies are growing extremely strong, when things are going really well, you'll find that they kind of they buy a lot more copper than they would gold. Gold being a safe haven asset, copper being basically an investment asset for economic growth. And when there's a lot of economic growth, there's a lot of demand for copper. You see copper rally against gold. Basically, we saw the same thing, kind of a fake out of that economic growth, the reflation that occurred in 2008. Then we go into a long drawn out, basically 10-year bear market in commodities, copper, gold, showing that. And then again, we have the 2020 crisis, and we go into those reflationary conditions, which kind of they haven't gone as high as I would like them to have gone. I would prefer it if it goes to the full target, up at 0.030. But we've already started to see a turnaround in this chart, what seems to be a turnaround in this chart, as we had this kind of final leg up here. And since then, we've had this pretty strong rally to the downside. Unless this forms into a corrective structure, what we would deem an expanding triangle, and starts to get another leg higher, it seems to me that a lot of these charts are showing basically an end of that reflationary trade, which we called for, and a step back towards the deflationary trade or the disinflationary trade, where economic growth contracts. It's more of a defensive position in the markets. The commodities demand dries up, and that's what we're seeing in these charts. So let's start with copper being the first one. Copper, we're looking at the higher time frame charts of copper. We had a big dip down in 0809, big reflationary trade for 2011, long drawn out dip down towards the lows in basically 2016, 2015. Started to rally there and then bounced back down to the lows of Corona. And then we just saw this really strong rally following Corona, that reflationary trade, very similar to what we saw 2008 to 2011. Now we expect this in terms of the structure to roll over in this area, and when we go to the lower time frames, that's exactly what we're seeing. I believe we're seeing the beginnings of that rollover. We have the first impulse off the highs, which kind of topped out in May 2021. When you're looking at May 21 as your topping out, even though inflation has supposedly gotten worse, then there's something saying that right there, that the narrative and the chart don't actually mix. This should have continued to rally if inflation was getting worse. And what we're seeing is a dip, what I believe to be a corrective structure for further downside, and a downside target for copper moving forward of around about 140. So as you can see, that's a big dip moving forward in copper markets. And how that's going to occur is that the demand for copper that has basically been on the cards, all of these copper mining companies, everyone using this copper rally and the belief that this is the start of the new super cycle to reinvest, start to push out huge amounts of copper into the market to match that demand. Once that demand dries up, you have a massive oversupply, and when you have that oversupply, you see copper dip like we saw in 2008, all the way from the peak at 433 down to the lows in 2009 at 125. So something very similar, probably a little bit more drawn out in terms of the structure of the price action, a little bit longer and drawn out, which we've already started to see. But regardless, it should see a downside target of around about 150 to 135, somewhere around there. And that's kind of started to play out already. When we look at platinum, we see the same thing. Platinum, another kind of industrial metal. As you can see, big impulse off the highs, 2008, 2009, big reflationary trade up into 2011, European debt crisis, 10-year drawn out bear market, reflationary trade of COVID, which seems to have died out even lower than expected, right at our minimum target level at 1330, 1350, somewhere around there. And we've already seen some serious price action that resembles big downside moving forward. You've got this big impulse off the highs, you go into this long drawn out corrective structure, and now we're seeing that big impulse to the lows. So we're already short platinum. We were already short back in May 2021, and now we just seeing another short position in platinum with a downside target of at very least these lows at kind of 550, somewhere around there. It's this 570, 550 region, probably even below that when we look at the chart and see where this potentially could go. You might even see 400, 450 there. So we're already seeing it in industrial metals. When we start to look at basically the main driver, first of all, we will look at the commodity index in general, the Thomson Reuters CRB index, and we see the same thing. When we zoom out onto that, you can see QE1, or 2008 crisis, big dip, QE1, reflationary trade, all the way up to European debt crisis, 2nd of May 2011, somewhere around there, or May 2011, June 2011, where we saw that turnaround, European debt crisis, 10-year drawn out bear market down into April 2020. Then we have that reflation trade, governments injecting liquidity into the markets, but there's no real demand for the economic growth that they want. So because the debt levels are so high, we see an early rally up into the 240 zone. This could get as high as 270, so just a caveat, but I just believe this may be the start of the downside. And what we saw on Friday, I believe, may potentially be the start of that move, because the CRB index follows a big weighting into oil. Oil is a big driver of the CRB index, and I'll show you now. If you just take a look at this chart, and we move over to the weekly oil chart, you'll see how the commodity index and oil track very closely. As you can see, got this big impulse off the highs, 2008, 2009, drags all the way up to the European debt crisis. Takes a while to turn, although that still remains the high in 2011, and then eventually drops into a 10-year bear market down into April 2020. Obviously, oil went negative there. And then we saw that big COVID rally, the big demand for oil, all the way up to, in this instance on WTI, all the way up to our full target of 85.70. And then what we saw, and if you guys remember from last week's presentation, we said oil markets are showing something very, very peculiar and maybe turning here. And what we meant by that was this little structure here, where we're seeing a little bit of a corrective structure. It resembles further downside to come. And then obviously Friday came around, we had this COVID variant, whether that's a driver or not. Thin markets may have played a role, whatever, etc., etc. We saw this massive dip. We saw 11% down, 12% down in oil markets on Friday. Big, big dip. So whether that recovers or not is the big question here. Members, I would move this trade to break even, because we are just sitting in that little dangerous area where you have your impulse, you have your correction, and you have your second impulse. You guys know the numbers. We're still sitting in that danger zone, and we've seen quite a little bit of a bounce here. So if this continues to rally up and maybe go into more of a double top, I don't want to ride that out, because oil may be quite resilient on the turnaround. But back to what I was saying, as you can see, if oil's right at that region where we could see that big turnaround, it makes sense that the CRB or the commodity index may turn as well as the inflation narrative. So we're seeing that. We're also seeing that in the UK oil market. Pretty much the same thing, same structure. Didn't quite make it to its full target, but definitely has done enough, reaching right into that region of the September highs of 2018. Can always be a pretty interesting area of support and resistance. As you can see, we don't use much support and resistance, but you can see how this is a very key area on the higher time frames, and we've started to see a turn there as well. So just some indication that we may be seeing a break in that narrative and a shift towards that deflationary narrative. Two more things. First one being the dollar. The dollar, obviously the narrative basically since 2020 in March was that the Fed is printing the dollar to oblivion. We're seeing an end of the dollar. The dollar's getting hyperinflation. All of these kind of Bitcoin maximalist theories that made a lot of sense at the time. But as we knew, as we measured, that we would be watching the dollar kind of drop down into this. Basically, the minimum target was 93.50. The full target was 87. We dropped right into that median target region at around about 90, and then started to shift to the upside already from there. So from the median target, that means the dollar is more bullish than we'd even expect, and we started to get that upside now in the dollar, which means that kind of dollar deflation, that dollar inflation, or inflation caused by dollar weakening, or fiat deflation, however you want to label it, is not a narrative anymore. It's no longer part of that narrative moving forward, because why is the dollar rallying if the Fed is printing us to oblivion? And what we see is a corrective structure, or from a classic Chartist point of view, you have this inverse head and shoulders with a big neckline that is not broken and retested. You can see from a outcharting point of view, you have this big impulse. We're still kind of not clear whether this is a wave failure to the downside and we're now impulsing up, or this is part of a bigger corrective structure which could see the dollar take a temporary dip down towards kind of 93 and then really take off in earnest from there. That's still on the cards. There's still a potential, something we'll be watching for. Members, we're still watching this euro US dollar trade for potential move up to 118. So we're waiting for our setup to line up. But as you can see, regardless of whether we get this short-term bounce in the dollar, we've got this head and shoulders on the euro as well, and we're starting to see downside there. And the same with the pound. We're starting to see downside from the pound. And again, if we're going to the commodity side of it, if commodities are supposed to be rallying and they're not, then you're going to see this turnaround in the commodity currencies like the Aussie dollar, the New Zealand dollar, and the US dollar CAD. And when we look at the Aussie dollar, US dollar, we can see, structurally speaking, if you go back to our 2021 market forecast, we said watch for price to get into this region here and then start to fall, and that's exactly what we're seeing heading into the end of the year. We've had a nice impulse off the highs after topping out in February. You've gone into this long drawn out running flat structure, and then since then we've just accelerated strongly into the next round of weakness to the downside in the Aussie dollar. New Zealand dollar, same thing. Big impulse off the highs back in February. ABC running flat, big impulse to come. Downside target of this move, just so you guys are familiar, is, all the way back down at the very least at the 0.54 region, but you'll probably find it's actually down at these lows at 0.50, kind of the 2008, 2009 lows, somewhere around there. So price structure just showing how weak these commodity currencies are. And one of my favorite charts, US dollar CAD, which is a good kind of indication for what we might see in oil. So we have this big impulse, perfect corrective structure, everything we look for, ABC, all the complexities that we need, all the kind of nuances that we look for, and then we turn right at the area where we expected to turn, and you go into the dailies, we've got into this big impulse off the lows, and we go into this A, B, C, D, E corrective structure. Still the possibility we get up to here, pull back once more, and then rally. But either way, it's looking very much like the US dollar CAD has bottomed, and we're off on the next leg higher, which will take us well beyond 1.50 US dollar to the CAD. So we're seeing that across the board. And then finally, we move into basically the risk aversion pairs, which is the yen. I'm going to focus on the yen for a little while now, just to show you the structures we're looking at there and why we believe we've turned there. And again, going straight back to our 2021 forecast, where we said watch for this to rally all the way into this 85 region, and then start to turn around from there. And that's exactly what we've started to see over the last few weeks. We've got this bigger ABC corrective structure, which is this one. Just to show you, this is the higher order pattern. You've got your big A wave up, nice long A wave down, B wave, very nice running flat structure. And we started to turn to the downside of the C of B wave, which will take us all the way down to the lows at 55 on the Aussie dollar yen. Very much a risk off move. And when we look at the structures, you see from basically March 2020, the reflation trade takes you all the way up into the end of the structure, and then we start to roll over. And if we go back to kind of 2008 to 2011, this goes all the way into 2013, you see how we have that reflationary trade. This time it's going to be muted because the economic damage is bigger, it's more global, and as you can see, that's exactly what we're seeing. We're seeing this roll over at the highs, and now we're starting to see some sustained downside on this move. Obviously, once we break these lows at 78, that will be pretty much confirmed, but we really started to see these yen pairs move. New Zealand dollar yen, same structure, all the way out to the weeklies. You expected a kind of topping out at this 82 to 85 region, and we've seen a strong turn from those highs, even stronger than the Aussie dollar yen. And you can just see how strongly that rallied on Friday to kind of confirm that risk off move that's happening. CAD yen, weekly structure, even cleaner than New Zealand dollar and the Aussie dollar. Beautiful little ABC corrective structure, topping out right where we expected to top out, and getting some pretty strong sustained downside in that. Members will cover this week, but we're looking for an expanding triangle to develop here. As we mentioned last week, we're waiting for that E wave higher, and then we can engage that short. Swiss yen, another one, big impulse off the highs, nice little running flat, and then a big move lower to come. So you're just seeing these yen pairs really rolling over, and that's just another indication that what we're seeing is a shift in narrative, a complete turn in the market narrative that we started in March 2020 and is now changing back to that deflationary environment. So watch for that. Keeping a close eye on oil here. Oil is going to be a major kind of indicator to us. What's going to be happening there. The yen's a major indicator, the dollar's a major indicator, and precious metals are a major indicator. And right now, they are all aligning towards a shift in narrative, which is just going to kind of catch a lot of people on the wrong side. And that's why we believe these markets are really going to turn. And that kind of draws out into something like the emerging markets, which we've already been seeing rolling over. EEM, mostly China-based. If you guys go back to 2021 forecast, again, we said watch for this to roll over. That's exactly what we've seen this entire year. It's been a very, very slow rollover because we went into a very long drawn-out correction, basically right from the beginning. Big impulse, A, B, C, D, E. Now we're starting to impulse to the downside. We've come out of correction, and we expect this to start to accelerate moving forward. When you go to Hong Kong, so you're seeing basically China being the epicenter of these moves. Hong Kong, as we said, would top out and then start to roll over, and has rolled over and continues to move to the downside with a weekly structure that indicates kind of 1400 to the downside. It's another 43% from here. That's a big drop. When we go to the Kospi South Korean index, We expected them to roll over, and that's exactly what we started to see this week and last week, in the last few weeks really, from July. We're seeing that roll over, broken an important trend line, and this little corrective structure here is indicating a breakdown of this fairly soon moving forward. When we go to US dollar currencies against emerging markets, something like the ZAR, where we said we're going to bottom out around about this 1340 region, that's exactly what happened, and we are now sitting at 1630. Big move to the upside. Brazilian real, big move from 14 June 2021 lows, continues to rally pretty strongly. The Turkish lira going parabolic. The ruble starting to shift to the upside. Ruble has some strength. They have a lot of gold reserves. They are a strong emerging market currency, but they're still under pressure. The Korean won breaking higher out of this multi-year triangle pattern and should break out really strongly. They're going to take some serious heat. So we're just seeing it across the board. We're seeing everything we've been looking for that shift of narrative to occur, and it's definitely starting to line up. And we believe that turn, we believe it started to happen in the early part of January, of the early part of 2021, early part of this year. As you'll see from our forecast, it's taken a long time to really start to shift, but those shifts are really starting to accelerate now. So we'll be keeping a very close eye on these markets moving forward to confirm that thesis that we have. It's cool, guys. As you can see, it's a pretty bearish outlook that I have right now, but everything's being confirmed that I was looking at from basically May last year in our friendly warning to friends and investors, also from our 2021 market forecast. So take a look at those, watch those, and you'll see that everything is lining up as we suspected it to, and we're starting to see those moves heading into the end of the year. So I think 2022 is going to be a bit of a rough one, but if you positioned well and you take advantage of those situations by reading the charts clearly, you can kind of preserve your wealth heading into these volatile times. That being said, we're still running our Black Friday special for the Trading Academy for the investors, our new investor guidance service. Go check out my Twitter feed, you'll see that there. I'll also put a link in the description below where you can find more details about that. And yeah, hopefully you can join us on this journey and take advantage of these moves and kind of join our network of traders and investors that are all aligned with this technical analysis framework. It's cool, guys. Have a good one. Thanks for watching. We will chat to you soon.